All right, so joining us next here is Alex Barrow from Macro Ops. How you doing, Alex?
I'm doing good. How are you doing, Patrick?
Oh, pretty good. So we asked you to come on because you're always posting so many amazing things out on the internet and on Twitter. So we'd love to hear from you. And so you were kind enough to put together a chart deck because we wanted to ask you to kind of tell us a great story, something about what's going on in the world. And so you started off with wanting to talk about. Everything from like demographics and the GDP of the world and so on. So why don't you take us through the story of what you put together in these charts?
Sure. Yeah. Well, first, thanks for having me on. I'm glad to be here with you guys. I'm a big fan of your show. And so this little presentation that I'm going to run everybody through is pulled from a recent report I did. And it's just kind of on one of the three biggest secular drivers that I see that are driving markets right now. And they're going to be driving markets well into the foreseeable future. So, I mean, as far as like the big things, it's really, as far as I'm concerned, debt, deleveraging the long-term debt cycle, being on the tail end of the demographic boom, which is what I'm going to walk you guys through today, and then the trend to deglobalization. So we can just kick off with this first chart. And this chart it's a horrible chart because it's a linear chart showing a geometric growth. So just ignore that for a second. But ask yourself, looking at this thing, what made this thing hockey stick and just start skyrocketing higher in the late 19th century, or I'm sorry, late 20th century? Okay, um, it's you had relatively linear growth, and we could go to the next chart after this. Um, so you had relatively linear growth for thousands of years, and then
Right.
sometime around the turn of the turn of the 20th century, about 1875 to 1925, you saw population explode higher. Um,
Right.
and so you're looking at this chart right here. I mean, it just kind of shows it relatively linear growth. Then you had exponential growth. So this just makes me ask the question, what caused this? All right, next slide. Okay, so if you look at this, we get our answers, right? So sometime mid 19th century, germ theory becomes accepted wisdom. Doctors learn the importance of washing their hands. About 50 years later, Alexander Fleming discovers penicillin. Antibiotics go on to be, popularized. They greatly extend average life expectancy. This means more people reaching the age where they can have babies. More people having babies means a one-off explosion in the global population rate. Next slide. All right. So this is why all this matters. And this is why it matters for the global economy and the markets right now and going forward. Because when you're looking at the global economic growth equation, all it is really is just the number of workers times total productivity. All right. So, and if you look at over the last 100 years, we saw that huge hockey stick parabolic run up in global GDP growth. Well, that coincided with the huge run up hockey stick parabolic jump in global population. And that's because global population is a critical part of the global economic growth equation, right? And so a lot of research has shown that well over half the exponential rise in global GDP during the 20th century was actually due to this rise in the number of workers. Next slide.
Right. Right. Right.
All right. So here's an awesome chart. I love this one. So this just shows that kind of hockey stick move higher. I mean, it looks like, like Bitcoin's chart, right, from a couple of years ago. It went parabolic. It peaked in 1968 at about 2.1%, and it's been collapsing at nearly as fast as the pace as it went up, right? And so now we're back down. We're at roughly 1% now population annual growth, right? And so this is super, super important. And I look at demographics because it's a critical point, as we just pointed out, of the GDP growth equation, but it's something that hardly anybody talks about or pays any attention to because it's such a kind of a long, slow burn thing. And so you don't really pay attention. And everybody's looking at, the credit cycle, which is important too, productivity. But it's this reason right here. That's what this whole low growth, low inflation environment we're in right now is due to, right? It's just we're on the other side of this massive demographic impulse, And so now we're starting what was tailwinds during the last 100 years. They're now becoming increasing headwinds over the next 100 years, and these are just only going to increase over the next decade or two. Next slide.
And actually, it's Kevin here. I just want to point out: didn't that 1968 top also coincide with the introduction of the birth control pill?
Yes.
Like, is that why we're isn't that why we're seeing that?
Yeah, I believe that was mid late 60s. So yeah, I think you're spot on. So interestingly enough, yeah, that's that's probably contraception is probably one of the biggest reasons, that, and then just rising GDP per capita. I mean, when people start making more money, they stop having less babies.
Yeah, exactly. And women entering the workforce as well would have contributed to that as well. The whole thing just comes together that has turned that tide of the demographics for sure.
Yeah, and it's huge. And so, I mean, here's just a few numbers just to kind of put all this into perspective. So in 1900, the global labor force was in the neighborhood of roughly 1 billion people. Well, over the following 100 years, that number more than quintupled to 5 billion workers. Now, from 2000 to 2100, the labor force is only going to grow by roughly 20%. I mean, so there's a huge slowdown in the growth rate. Right? The UN predicts that we're going to see peak population growth in the next 80 to 100 years, and even then, they've been overly optimistic in all their population forecasts so far. And so, if you look at the 20 to 64-year-old population, it's expected to grow less than half as fast from 2015 to 2040 compared to the prior 25 years. Meanwhile, the 65 plus population is going to 5x faster than the working age population over the next 25 years. And so there's a bunch of really interesting research on this. And some of it shows that this demographic shift is going to lead to the global economy being 20% smaller in 2040 than if we were just to extrapolate the current demographic tailwinds out for the next 25 years. And so, I mean, 20% smaller total GDP is, I mean, that's huge, right? I mean, because we're talking about small numbers as far as like the change in the growth rate, 1 to 2%. And it doesn't seem like that big of a change, but I mean, it's the whole power of compounding, right? You play that out 1 to 2% over 10, 20, 30 years leads to massive differences in outcomes.
This sounds very deflationary, doesn't it?
It does, and I believe one of you guys is a fan of the whole deflationary secular
That's
thing.
where I was going with it. So I'm just gonna sit back. I'm actually gonna right now go grab a bag of popcorn because I'm gonna sit back and enjoy the rest of this presentation for sure. Go on. Anyway, keep going, Alex.
Yeah. So this is just a chart that shows the expected difference. And the blue line is where everybody thinks the global GDP is going to be in 25 years' time. Then that's just, again, extrapolating out the current demographic growth trends. But the red line shows where it's likely headed with where the growth rate is currently trending. And so that's 20% drop in global GDP versus where it would have been 25 years down the road. So next slide. All right. Yeah. And so here's another great chart. This is from KKR. And it just shows how important demographics are in factoring in GDP growth, right? So they're predicting when you go out 10, 12 years, real global GDP growth is going to drop below 2%. I mean, and so that's huge. I mean, we're currently forecasting it. If you go look at like IMF forecasts for global GDP going out the next 10 years, it's roughly 3.6, 3.7%. Which is, relatively where we've been the last 10 years. And so to see a drop, and we're going to see a drop of maybe potentially half that, again, like the power of compounding, this is going to have a huge impact on the global economy and especially a lot of emerging markets. Next slide. All right. So, yeah, I mean, just to basically drive home the point. So the next 100 years is going to look nothing like the last 100 years. There are also a number of other positive one-off demographic and productivity impulses that are now fading that happened in the previous 100 years. And you touched on one of them earlier, but one of them is the ManQ extension, which is basically just a huge improvement in early education over the last century. It's been a while since I read up on it, but I remember reading something like at the early 1900s, the average time spent in school was like 4 to 6 hours. Most kids didn't even go to school because they were working on the farm, and school wasn't very structured. I mean, you compare that to where we are today, that the increase in the quality of our education has had a huge impact on productivity over time. And so it's going to be tough. If you look forward, it's going to be tough to see how we can have a similar impact by increasing education that dramatically and improve our productivity. Right. So the other one is improved labor matching function. That's just a fancy word for saying bringing more women entering into the workforce, doing other jobs other than being a secretary or a nurse. Now they can be CEOs or whatever, and so that greatly improves the overall productivity of the economy. And then there's also a bunch of research, some by Cesar Marchetti. I think he's at Stanford, that shows as laborers age, their productivity drops, and that's just not manual labor. That's also skilled knowledge work. And so, when going back 50 years ago, our labor force was on an average basis was a lot younger than it is today. So even if our labor force is still large, it's aging, and that aging is weighing down on our productivity or on our overall total productivity. And so this just brings us to the point, and this is super important, right? That's global GDP growth is now structurally lower, and there's nothing we can do about this. I think that this is the primary cause of secular stagnation. Real GDP growth is going to drop below 10% or 2% over the next decade, and it's going to stay there. So, I mean, unless we create like general artificial intelligence, and that somehow causes a huge explosion in productivity, which I'm not going to bank on, this is our new reality. And I mean, obviously, this is extremely impactful because this changes everything, because our current economic system is predicated on high and continuous growth, because that's what we've had over the last 150 years. And so that's what everybody's come to expect. I mean, that's what the whole leveraging system is built upon. I mean, that's how we're able to accrue all these large amounts of debt, because we assume that, we're going to become more wealthy in the future, and we'll be able to pay off that debt, and it's going to be lower relative size to our future incomes. So that's not going to be the case. And so obviously that's going to drive a lot of different trends and markets in the economy over the next couple decades. Next slide.
So yeah, go ahead.
Is that it?
Yeah. Well, no, sorry.
Yeah.
Go ahead, Alex. I was just going to ask, what does this mean for an investor? How do you take advantage of this?
Yeah. So, and I think that's why a lot of people don't pay attention to it, because it's hard to kind of connect the dots. But I mean, obviously that this is an extremely deflationary force, right? Or disinflationary force. I mean, there's a ton of research shows that when people age, especially when they retire, they consume less. I mean, I think if you give somebody with a job and basically a consumption coefficient of 1, then somebody who's unemployed has a consumption coefficient of 0.85, and then somebody who's retired, it's 0.65, right? So, I mean, they're consuming, roughly 35% less than somebody who's employed. And so, I mean, not just, the growth rate in the actual demographics is going to affect GDP growth, but it's also just going to change the overall consumption habits of your basic consumer, right? Because old people consume a lot more services than they do goods. And so for a really dynamic, healthy economy, you need homes being built, cars being sold, big ticket physical items. And I think, I mean, if you look at like home sales or auto sales, especially, I mean, they're at like secular lows, and people are scratching their heads. And there's a number of reasons for that. I mean, one is just technology has improved, so people don't need to replace their cars as often. And two, the consumer's just over leveraged. If you look at car prices relative to incomes, they've gone up over the last 50 years. And so it's just too much of a drag. Consumers can't afford it. But it's also just that your average consumer is getting older, and retirees don't want to buy a new car. They're they got to save their money and spend it on health care and vacations to South Florida, right? Yeah.
Right.
So if you're looking at all this stuff, I mean, we're in a low growth, low inflation economy, and that's just going to be our economic reality going forward.
Love it.
And so and you look at this because nobody understands this, right? I mean, very, very few people understand it. I mean, policymakers don't really understand it. I mean, some pay a little lip service to it. And I don't know why that is. Maybe just because it's not really understood, or maybe because we can't. I mean, it's just we can't do anything about it. We can't go make people have more babies to really make a difference. But I mean, if you play this out, this is, I think, this along with the turning of the long-term debt cycle and all that. I mean, everything Bridgewater talks about these are what driving the trends in populism, because people are frustrated. Things aren't as good as they were, 30 years ago. Nobody knows who to blame, so it's like the akin to, people going to their shaman to try to bring rain, right? They don't understand the problem. They just want results. And so you see a rise of populism. This populism is obviously going to lead to deglobalization, which we're already starting to see in the beginnings of. And it's also going to lead to, I think, more experimental monetary and fiscal policies. I mean, that's why we're seeing the whole talk of MMT, and you see Teltros and the ECB. And I think we're going to see more of these tools develop, because we don't fundamentally understand what's driving this new environment. So, we're going to look at all these other monetary and fiscal policy experiments to try to drive growth. But until then, until we get like an MMT on steroids, I don't see how we're going to get any type of actual sticky real inflation. I mean, like in my mind, obviously the trade is U.S. bond yields are heading to zero. We're all following in the footsteps of Japan's. So,
oh my God, you make me so happy, Alex.
You're welcome. I
oh
wrote
my
that
God, I
one for
love
you.
this guy, Kev. This is one of the smartest guests we've had on the show in how long?
Yeah, but Patrick, read the next part of his slide.
Okay, all right.
Like, he's actually like,
all right, okay, okay. No, let
letting
Alex
out that
finish.
he's
Okay,
letting
okay,
out-
Alex,
Yeah.
go finish.
So
finish your
well,
sentence.
I can sympathize with Kevin for sure, because I bought bonds. I put out a big report calling bonds the best buy back in November of last year, and then I sold out like a month later, and I thought I was really smart. So, and I've been sitting on the sidelines this whole entire time, just kicking myself for not holding a position, and I've just been looking for tops this whole time. But so.
Yeah.
Like on a short-term basis, I think bonds are extremely overbought, and I think we're going to see a pullback sometime soon. Maybe not, but I think the broader trend is definitely lower, barring the introduction of any new experimental monetary or aggressive fiscal policies, which just are. I mean, they're not going to happen until things get really bad. So I think that's a few years out. So I think the yield curve is it's all going to. There's a big strong attractor at zero, and that's dragging the whole curve down. Okay, so. And then that just brings us to what do we want to own in the world with increasingly experimental policy makers, right? And so for me, that's real assets and deep value. Gold and energy stocks are two of my favorite things, and shipping stocks, but we're going to focus on gold and energy stocks today.
Well, you know what? I was just gonna say, like, Alex, maybe you should come to Chicago, and you can stand in my place and give the spiel to Kevin.
Well, or you know what? Maybe he could take my place, and you guys could have a kumbaya festival. You guys could just tell each other how like rates are going to zero. But actually, I look at I want to let Alex finish, but I look at what he's saying, and I don't disagree with it. I only disagree with his part that until we get some MMT policy on steroids. And I think that's coming sooner rather than later. But anyways, let's just let Alex finish off, because it's interesting where he's going. He's going to the same place that I actually think, which is real assets are what you want to own. So regardless of in terms of timing, I think we're in the same camp. So Alex, why don't you tell us what you want to own and why?
All right, cool. Yeah, let's just hop in the next slide and we'll get to it. Yeah, so I mean, just here's a basic chart showing commodities versus equities. Commodities have been in a long-term downtrend. Next chart.
Oh, all right, there we go.
All right, yeah, here's a chart that we published a couple months ago, just talking about gold, how gold was likely setting up for an explosive move. Because one of the things we look at is just contractionary regimes. If you're looking at it from like a volatility perspective, the red line down below is just the width of the Bollinger Band, which is another way of measuring price volatility. And so usually these contractionary regimes lead to expansionary ones, which is just another name for big trends. You can see the last time that volatility and contracted that much was 2002, which preceded the last major bull market in gold. So this was obviously on a radar and something we were looking at. Next slide.
All right. Oh.
Yeah, go back. Yeah, yeah. And so here's another one. You guys have all seen this. Has been getting passed around on Twitter, and it's just gold to silver ratio. Um, and it's just like one of those things when you see gold become this extended relative to silver, that in the past has often sometimes coincided with major bottoms in gold. Not always, but it's a decent indicator worth looking at. And usually going forwards, precious metals outperform, and silver outperforms gold. Next slide. Okay, so I mean, looking at this recent spike up in gold, I mean, we're now above the significant 1400 level, and it's out of its multi-year consolidation zone. I think that this recent move is just all being driven by the lowering of real treasury yields. So this is just an inverted real 10-year yield right here. And then also, I think a kind of growing concern and building of the narrative around the independence of the Fed. I mean, because Mr. President Trump is likes to bash Powell and stuff like that, and so that's calling into question the Fed's independence. And I think it's really those two things that are driving the price of gold higher at the moment. Next slide.
Yeah, so I'm gonna jump in there with 1 second, Alex, because it's Kevin. I completely agree with you that is what's driving gold. I think a lot of people think gold moves with inflation, and I argue that it doesn't move with inflation because if you look at the big move in the early 2000s, it wasn't accompanied with a lot of inflation. What it was accompanied by was a drop in real yields. And people think, oh, it happened in the late 70s, early 80s. But what they don't realize or what they fail or they kind of just gloss over is the fact is that the reason that inflation rates they didn't rise as much as inflation. So real yields during that period was also very low and, in fact, deeply negative. And that is the point that you kind of have that I think that gold investors should remember. What's most important for gold is real yields to be low. So when we had Powell pushing really hard and raising rates, he actually pushed the 2-year tip yield out to the highest point that we've had over the last 8 years. And he broke it out. It had previously been in a range of 50 basis points to minus 100 basis points. And he pushed it up from 50 basis points to 150, maybe I think even 200 basis points. And I think that's why gold didn't go up during this point, why it struggled. And then once he went away and once it became clear that he was going to allow real rates to go back down, that was the all clear for gold. Right. And that's how I feel. But I love that chart. I think that's a terrific chart that you had. And I just wanted to kind of say kudos. That's a great way of looking at it.
Yeah, and those are excellent points. And I totally agree with everything you said. I don't know why. I mean, how that idea of just inflation being the main driver of gold ever was born. I mean, I could see why, but I mean, people just don't check up on it. And it's real easy to check, inflation and real yields and gold, and just see that correlation doesn't really exist. So you can have gold rise in a deflationary environment. You can have gold rise in an inflation environment. Inflation isn't as important as the cost of money, and also just concerns over, I think, the soundness of institutions that control that cost of money. It's also like if you look at gold on a year-over-year basis, like relative to the S&P relative to EM stocks, they also track each other, right? Because when money flows out of the U.S., it flows out of the U.S. dollar into EM stocks. Gold also gets that same bid. And so it's almost like a perfect one-for-one correlation. And that's because, gold, another way of looking at gold is just as a reflection of the internationalized fundamental value of $1 US of liquidity.
Right.
So anyways, so this is just, a chart of gold, and I just really like it because I like looking at technicals, and it's a beautiful technical setup, right? You have a little over six years of sideways consolidation, and then a huge impulse move, break above 1400.
Yeah, Alex.
Okay. Alex, 1 second. I'm going to interrupt Patrick. So your other big call is energy, and so why don't we go quickly through these charts?
Oh no, you're not leaving gold here for a second, Kev.
Well, we're running short of time, Patrick. So
all right, we'll talk gold back in the post.
Okay, right. So let's just keep going. Let's go through the energy.
I'll run through them. Okay, so I'll do these real quick. Oil stocks have been beat up. If you look at them on a 5-year annualized basis, they have their worst 5-year annualized return in history, right? But I also look at things from a capital cycle perspective. So increase in capex leads to increased future supply. That means lower prices, and then this thing just plays out where capex gets brought down, supply contracts, and the prices eventually go up. Well, we're we're coming out the tail end of one of the deepest, most extensive reductions in capex in industry history for the global oil and gas industry. So I think it's a really interesting time to be looking at oil and gas stocks. This just slide shows a weekly rig count change for U.S. oil rigs, and you can see that capital discipline is coming back because investors have been punishing those who keep on just pumping a bunch of unproductive, using a bunch of unproductive rigs when the price of oil goes up, trying to get that revenue growth. And so we've seen oil rise over the past couple 6 months. 12 months, but you're not seeing rigs come back online. That's because companies are sticking with their most productive rigs, and that this is actually improving margins. Next slide. All right, here's just another slide that shows this whole thing. CapEx is low, operating margins are improving for the industry as a whole. Next slide. And then finally, this is just something you want to see. It's earnings momentum for energy producers in North America. You can see, so this just measures the surprise of the actual earnings relative to analyst expectations. It's something I like to look at for industries, especially cyclical industries. You can see the last time, the late 90s, when the last time the oil and gas sector bottomed before it started a major cyclical bull run, the earnings momentum bottomed from really negative place and started trending up. We're seeing that again now over the last 2 years. And I think that's it.
Yeah,
that's it.
All right.
So, Alex, that's a fascinating story you told. I love where you ended up. I love being long both energy and gold. We're going to talk about this more during the after hours, so Patrick will get his chance to opine about gold, and we'll hear that. In the meantime, why don't you tell everyone where they can find you on Twitter and your website and what you guys do, and just kind of let people know where they can reach you.
Cool. Yeah. So my Twitter handle, you guys can find me on the Twitter at MacroOps, and then our website is just www.macro-ops.com. So you could Google that or whatever. And then just stop by our website. We're a macro research service, run a newsletter, internal forum, all that jazz. And so that's about it. That's my plug.
Well, it's great. I love all you're a big fan of putting up ideas from previous traders and trading history. And I always love when you kind of quote your market wizards and all those different things. I think you're a great Twitter follow, and I just encourage everyone to make sure that they check you guys out.